Welcome to Session 7 in the 30-Day Financial Planning Strategy. Investments can be overwhelming if you don't have any experience in it. In this session, we discuss the mechanics of investments, lifting the veil of confusion, so anyone can better understand how investments work. Investments are a cornerstone of financial planning for several reasons, including wealth building, inflation protection, diversification, income generation, tax efficiency, and achieving your financial goals. But to understand investments, you need to understand the underlying mechanics of investing first. All investments are made up from investment funds, managed by investment houses that in return can be divided into asset classes, or vehicles as it is referred to in the financial industry, that is specific to the goal that needs to be reached. Let's look at each to make it easier to understand. Asset classes. This is your starting point when you are considering to invest, taking in account the risk and possible return associated with it. Examples of asset classes include cash, property, bonds, and equities. Fund houses. All investments are managed by a fund house, like 91, Allen Gray, Coronation, or PSG Wealth. After deciding on the asset class or combination of asset classes that you want to invest in, you need to appoint a fund managing company through which you will make your investment. Investment vehicle. The investment vehicle you decide on is important with regards to the outcome that you want to reach for the goal. For instance, if you are looking to invest your retirement funds, vehicles such as living annuities, preservation funds, unit trusts, or voluntary investments are some examples of products you can choose from. When deciding on an asset class or underlying fund, it is essential to keep the goal of the investment, as well as the outcome needed, in mind. Short-term investments should be invested in less volatile funds, whereas long-term investments can be invested in a higher volatility fund, but with a possible higher outcome in the end as markets fluctuates. The overall principle of investing is time within the market, and not timing the market, as trying to predict the market is not a precise science and can let investors down in the long run. To compare the risk and return on any investment, it is best to start with the percentage return that a zero-risk investment offers, such as what a cash or government bond will yield, and then compare the relative risk involved in a higher possible outcome with regards to other asset classes or funds. And lastly, but equally as important to understand, the percentage quoted on any investment are structured as annually, and then divided by 12 months to get to the monthly return. For example, if a vehicle offers a 12% return on investment, the actual growth will be seen as 1% per month compounded, as the quoted return is always divided by 12 months. Understanding that investments consist of three mechanical parts: the asset class, the investment fund house, and the type of vehicle, and understanding how return percentages are calculated, breaks down the complexity of investments. Always remember that higher return funds are more suitable for long-term investment, and the higher the return on the investment, the higher the risk associated with it. Entering the world of investing doesn't have to be overwhelming. Your financial advisor can assist you with your first or next investment goal.